Hello guys, this is Pojita Harish and I will be uploading CA interviews with detailed explanation and solving it completely. So please do like, share, comment and subscribe to my channel, and because that keeps me motivated to do more videos. Thank you guys. Today I'll be discussing about various leverage ratios or long-term ratios. The next type of ratio is long-term solvency ratio. Long-term solvency ratio, or it is also called as leverage ratio. Leverage ratio. What these long-term solvency ratios do is they measure the long-term stability and structure of the firm. Okay, and it also provides mix of funds provided by owner and lender, and it also ensures that the lender is getting periodic payment of interest. Lender is getting periodic payments of interest and the repayment of the loan. So long-term solvency ratio or leverage ratio is divided into two parts. One is capital structure ratios. Capital structure ratio. Another is coverage ratios. So under capital structure ratios, there are 6 ratios. First one is equity ratio. Second one is debt ratio. Third one is debt to equity ratio. Fourth one is debt to total assets ratio. Fifth one is capital gearing ratio. And the sixth one is proprietary ratio. Okay, there are 6 ratios under capital structure ratio. Now coming to coverage ratios. There are 4 ratios under this. First is debt service coverage ratio. Second one is interest coverage ratio. Third one is preference dividend coverage ratio. And the fourth one is fixed charges coverage ratio. So you have to remember, in liquidity ratio we had 5 ratios. Under long-term solvency ratios, there are 2 main ratios called capital structure ratio, coverage ratio. Under capital structure, we are having 6 ratios. Under coverage ratios, we are having 4 ratios. So the total ratios in long-term solvency ratio is 10. 6 plus 4. There we had 5. Now we'll see in detail all these ratios. First one is equity ratio. Equity ratio is equal to shareholders' equity divided by capital employed. So this ratio indicates the proportion of the owner's fund to the total invested funds in the company. And it is also said that higher the shareholders' equity proportion, lower will be the risk. So the next ratio is debt ratio. Debt ratio. It is equal to total outside liabilities divided by total debt plus net worth, or another formula for this is equal to total debt divided by net assets. This total debt or total outsiders liability includes all the short-term, long-term borrowings from financial institutions or debentures, bonds, or deferred payments for buying the capital equipments or public deposits or any interest bearing on the loan. The third one is debt to equity ratio. So debt to equity ratio is equal to total outside liabilities divided by shareholders equity, or total debt divided by shareholders equity, or long-term debt divided by shareholders equity. Sometimes if total liabilities is not given, then long-term debt will be used, that too exclusive of the current liabilities. And the shareholders equity will be equity, preference share capital, preference share capital, and the accumulated profits, but excluding the fictitious assets. The higher the debt equity ratio, the lesser will be the safety for the creditors. The lower the debt equity ratio, wider the safety for the creditors. So this ratio indicates the proportion of the outside debt, that is debt and the owner's fund. And this ratio is also the indicator of the firm's financial leverage. The next ratio is capital gearing ratio. Capital gearing ratio. It is equal preference share capital plus debentures plus other borrowed funds divided by equity share capital plus reserves and surplus minus losses. This is calculated to know the fixed interest for the capital. The next one is proprietary ratio. Proprietary ratio is equal to proprietary fund divided by total assets. The proprietary fund includes equity share capital, preferred share capital, reserves and surplus, but does not include fictitious assets and losses. This proprietary ratio indicates the proportion of the total assets financed by the shareholders. So these are the above mentioned are capital structure ratios. Now we will see the coverage ratios. The first one is debt service coverage ratio. Debt service coverage ratio is equal to earnings available for debt services divided by interest plus installment. To calculate earnings available for debt services, what will be included? Earnings available for debt services. What it includes? It includes net profit after tax plus non-cash operating expenses like depreciation, amortization plus interest and other adjustments like loss on sale of fixed assets, etc. So in the place of net profit after tax, we can also use net profit before tax as the case may be. So if the ratio is 1.5:2, then it will be called as satisfactory. The next one is interest coverage ratio. This ratio is also called as times interest earned ratio. So this ratio, it indicates the firm's ability to meet the interest rates. And the formula for this is earnings before interest and tax, that is EBIT divided by interest. The next ratio is preference dividend coverage ratio. So that is equal to EAT, that is net profit or
earnings after the tax divided by preference dividend liability. Preference dividend liability. Okay, this is the ratio which measures the ability of the firm to pay dividend on the preference shares. The next ratio is fixed charges coverage ratio, and the formula is EBIT plus depreciation divided by interest plus repayment of loan divided by 1 minus tax rate. Also watch my costing videos with detailed explanation. All illustrations have been solved and posted. I'll provide the link in the description. Please like, share, comment and subscribe to my channel and press the bell icon for more videos.